The next 90 days for the stock market are absolutely critical. Some people are going to make millions of dollars. Some people are going to lose millions of dollars. And everybody wants to know, is the market going to keep going down? Is the market going to rebound and go higher? Do we buy the dip? So Tom Lee just did a brand new interview on CNBC. He just dropped it, and he said some pretty crazy things about the market. He's kind of saying maybe we could buy the dip right now, but there is this one big issue going on with the market that if it plays out in that bearish scenario, the market will keep going lower. So I'm going to play the interview with Tom right now. It's about 4 minutes long. After we go through that interview, I'm going to give you my detailed breakdown on what I think is going to happen with the stock market. So here we go.
Bring in Tom Lee, Fundstrat co-founder, managing partner, and Fundstrat Capital CIO. And I can just see you. This is Tom playing out exactly as you said, choppy. You said exactly this. You said choppy for how long? But then the S&P again starts moving. And this is not, I don't think, an obvious or a logical conclusion to have right now with all the bad news that we're hearing about these policies. Everybody thinks the market's headed lower.
Yes. But instead, we could be bottoming, maybe this week.
And this is the choppiness you were talking about. And, you know, I think you use a combination of fundamentals and technicals, obviously,
yes,
to get things right. And the reason for the choppiness was going to be the first 100 days of this fire hose of executive orders and everything else.
Yeah, that's right. It's kind of weighing on investors' minds. We're seeing it even in the surveys and CEOs because the tariffs and Doge are, you know, the Doge is creating austerity. Tariffs are creating uncertainty. Businesses are maybe sort of sitting on their hands. This is why I think markets have been sort of sinking and momentum has done so poorly. But to me, Friday was a good day because, you know, it was a bad news headline, but markets actually rallied.
What is the fundamental and the technical backdrop for bottoming happening this coming week?
Well, you know, I think the best way to define a bottom, and Tom DeMark has mentioned this before, is stocks rise on bad news. And so Friday was maybe the first sign of bad news and markets bottoming, but I know our technician, Mark Newton, doesn't think we're there yet. He wants to see more signs of exhaustion, but we've seen sentiment turn negative. So maybe Friday, you know, but it could have already bottomed too.
Tom, you've tried to remain pretty optimistic through all of this. Are you still?
Yeah, I am optimistic. I mean, I can understand why investors are sitting on their hands. I mean, they don't really know how severe these tariffs are going to be, how long they are, but now we're seeing a big price correction, a decline in sentiment, and then something like today, we got a bad ADP jobs report, and the market's actually up. So we're actually rising on bad news, which is a good sign that a lot of bad news is priced in.
But do you agree with Adam that the first half of the year is likely to be a little more choppy and that you can get through some of these issues here regarding trade, and then you look down the road to tax policy and think that, okay, well, that's going to usher in a better back half of the year?
I mean, in fact, what's just happened in the last
tax policy, excuse me.
Yeah, I mean, what happened in the last 6 weeks is essentially a bear market that has swept through sentiment and positioning, right? Because if you look at hedge fund positioning, it's gone almost neutral and a huge correction in momentum. So I think it's very possible that March, April, May could actually be like one of these huge rally months where we're rallying 10, 15%.
Even in March. I mean, as we're sitting here, you know, we're going to be driven, obviously, by more tariff headlines. We do have to consider the fact that earnings could take a hit. Do we need to reassess that?
I mean, look, I think if stagflation were a stock, it's up off the low. That's why the market has been choppy. People are worried about, you know, a slowing economy, Walmart, consumer confidence, retail sales looking a little light. At the same time, they're worried about, you know, higher prices. I don't think that's ultimately what's going to happen.
So you'd be short that stock?
I would be. I just don't know. Maybe I think Tom is shorted today, and I maybe would say
it's
I maybe would be shorted in a couple months, but I think we're, you know, in the same mindset that we'll get on the other side of this at some point, probably in the second quarter. I just think it's hard to get through it until we really understand. If you're the CEO of a company that's a big company and you've got facilities and customers in Canada and Mexico and China, et cetera, I just think you're a little bit, I like his phrase, sitting on your hands a little till you understand a little bit more about how to most productively deploy capital. I think that usually takes probably through April earnings and guidance, and then I'd probably kind of be more optimistic that we have a certain path.
I mean, it's one thing for CEOs to be a little skittish, be a little more cautious. I mean, that's what they get paid to do. Investors often have to place their bets before something takes place. Is this a buy, this unsettled market that we've witnessed recently?
I mean, yes. In my mind, we put out a piece yesterday just talking about the 10 best days that happen every year. Last year, for instance, the 10 best days added up to 21 percentage points of the S&P. X those 10 days, the market was only up 4%. So, you don't get 20% years because it's good through the year. It's just the 10 best days. I think the setup for a 10 best day is near because if the economy's near stall speed, I think people realize the Trump put does come back because otherwise it has to unwind all this austerity. And if the job market's soft, the Fed put comes back into play because the Fed doesn't want to play with stall speed. And I think that's what is going to be the positive catalyst in the next couple of weeks. And on top of that, we already know stocks will bottom before bad news peaks. And so if we're seeing the market not fade on bad news, that means we're already priced in a lot of things that would scare us.
So there's three key things that we have to talk about right now about what Tom Lee just said, because his next 90-day prediction for the stock market is pretty much to go up. I'm going to break down the three key things that you have to know. So number one, and it's 100% accurate, the 10 best days in the stock market last year contributed 21% to the return. But if you missed the 10 best days, your return only would have been 4%. So ask yourself this question right now. Are you good enough to know when the 10 best days in the stock market are? And if you are, then maybe you're like the best investor of all time. But honestly, most people are not that good. You're not going to know when the 10 best days in the market are out of 365 days. That's crazy. And basically what he's expecting is like we're pulled down so far, we're so oversold right now that it's very likely the 10 best days in the market are going to happen pretty soon because we're just so oversold. People are going to start to buy the dip. If any, hint of good news comes out with tariffs, inflation, interest rates, anything like that, the market could rally super hard on that stuff. So me personally, I am positioning to capitalize on that stuff, but I am keeping a little bit of buying power on the sidelines just because if the market goes a little bit lower, because it's very, very hard to time the bottom perfectly, if it goes lower, I have buying power ready to go to capitalize, whether I buy calls or buy shares, whatever I decide to do. Now, number two is pretty much like the overall economy. Everybody is worried about Doge cutting jobs. All these people are going to be unemployed, and it's going to spike the unemployment rate, and there's not as many job postings out there, so these people might sit on unemployment for a while. And the United States economy is a consumer-based economy, so when people stop spending money in America because maybe they don't have jobs, they're not going to go spend money, the economy is going to go down. We're going to see quite a bit of slowing growth. I know you've seen a lot of the numbers coming out lately where the economy is slowing, the unemployment rate is going up. There's just negative things coming out about the economy. But here's one of the key things you have to worry about, and then we'll get into number three, which is a big needle mover to understand what the market's going to do in the next 90 days. But the big needle mover is the Federal Reserve. So just think about it. If we slip into a recession, if the economy starts to go down the tubes, what is the Federal Reserve going to do? Well, we're at 4.25 to 4.5% right now on interest rates. What could we do? Think about what happened when we had the pandemic. We cut rates to zero, and in the middle of the pandemic, the bottom of the pandemic, the worst part of the pandemic, the stock market started to rally because the Federal Reserve cut rates to zero. They started printing money and they went to support the economy. The economy loved it. So we have a lot of ammo on the sidelines, also a lot of cash on the sidelines. You heard him talk about how the hedge funds sold out a lot of their money. They have money on the sidelines, maybe in money markets or bonds. So when all this stuff starts to blow over, they're then going to go put this money back into the market, and the market could very well go hit new all-time highs pretty soon. So that's why Tom is basically saying the next 90 days, there's a lot of opportunity for the 10 best days of 2025 to happen. And I really, really just want to stress this hard. If we go into a recession, the Fed could cut rates to zero overnight to support the economy. But number three, which is the whale in the room, we have to break down this chart right here and then we're done. So I posted this on X a couple days ago. The green line right here is the S&P 500 for Trump tariffs 1.0. This was his first term in office. Now, if we go to the red line right here, this is currently what's happening in the market right now. So you could see a lot of volatility going on right here. But if you were just patient in his first term, you would have started out right here and ended up much higher. So right here on this ETF, you're at roughly $100 a share. You would have ended up at $111 per share, so an 11% return. But if you would have panicked and sold out right here, this was honestly the worst possible time to sell out. So what was happening in all this volatility right here is he was negotiating with China and various other countries to get his agenda pushed through with tariffs. So as, he was getting real hard on tariffs, the market went down. But then as we got a little bit of relief on these deals, the market went up and then up, down, up, down. So you got to understand that nobody likes tariffs. Nobody wants to have the stock market go down. But Trump is using tariffs as a negotiation tool in order to get a better trade deal for America or whatever he's trying to do with the drugs coming in from Canada, China, and Mexico. He's trying to use tariffs to negotiate that stuff. And then once the deals get finalized, the market goes way up. Then maybe he threatens new tariffs, goes down, goes back up, goes down, goes back up. So in the long run, I think if we be patient in the stock market, we will be okay. We're just in the depth of this first tariff run right here because the market was super euphoric going into the Trump presidency. He gets into office, and then it's kind of like newsflash. Maybe we are going to get tariffs. Maybe the economy is weakening. Maybe Trump's policies are really going to hurt the economy. All this stuff could happen. So that's why the market's going down because we just had back-to-back 20% years. People are honestly just taking profits. So I'm not saying to go YOLO call options right now. I'm just saying to understand the fundamentals, understand what you're buying at what price level, make conservative plays with stock options, and just keep your emotions in check. Nobody likes to see red in their portfolios, but if you're a long-term investor and you be patient in times like this, you're probably going to do just fine. So hopefully this video helped you guys out. If you want to watch a really good video that I just made, the 7 key habits that you have to know right now if you want to get to a multimillionaire status, watch the video below. I linked it in a video description. I'll see you guys in that one.